coming to you live from the JP Morgan India Conference, and we have with us right now Jahangir Aziz to talk about what the state of the economy, not just for India, but for the world is looking like. Jahangir, welcome to ET Now. Good to meet you in person.
Thank you.
What's the world view right now? And let's start off with the US. Where is this tariff war going to head?
Look, so I think there is a sense in the market that with all of these trade deals, let's leave India aside for the time being. With all of the trade deals, there is a sense that the tariff or the trade war is settled. I think it's far from settled. So if you look at the tariffs, almost all the tariffs were used using the IEPA Act, International Economic, I forgot what IEPA stands for. That's what the reciprocal tariffs were. That's what the fentanyl tariffs were. And we have been tracking this a while, saying that there are major legal challenges to it. We had one challenge that was heard by the U.S. Court of International Trade that ruled that the IEPA tariffs were illegal. That went to the U.S. District Federal Court that upheld the lower court ruling. And now it's up to the Supreme Court. The Supreme Court is going to hear it in the first week of November. It hasn't said when it'll hear. But if the Supreme Court also opposes the lower court rulings, then all of a sudden the basis of most of the tariffs, not all, most of the tariffs on all of these countries essentially is invalid. And then so are the trade deals. And then we go back to the drawing board saying that what are the alternative, and the U.S. has alternative ways of reimposing the tariffs, but those ways, those avenues that they have, the nature of the tariffs will be different, the countries will be different, and quantum will be different, and the sectors will be different.
But assuming that there would be tariffs in whatever form or quantum or whatever, are we looking at slower global growth in the times to come?
Yes, and I think that what has happened over the last, I would say, 3 quarters, since the tariff concern started, which was back in November last year, I think that is essentially camouflaging, is being camouflaged, that slowdown is being camouflaged by several things. One is the reaction by U.S. corporates to front-load imports, which had a massive impact on the rest of the world, particularly in North Asia. So that was the first thing. The second thing is that the slowness with which the tariff increases are being passed on to inflation is because, again, U.S. corporates are absorbing most of the tariff increases on their balance sheet right now, on their profit margins. There are obviously clear limits to how much you can absorb on your profit margin. Sooner or later, that will get passed on to consumers. We expect that to happen in the 4th quarter. So there you are going to see a spike in inflation. And from there on to consumption in the U.S. on the labor market itself. The labor market itself is softening. And the third bit, which is where I think most of the camouflaging is that alongside all of this tariff wars, completely independent of the business cycle, is the tech cycle. The tech cycle has nothing to do with the business cycle, right? And the tech cycle has been enormously powerful. U.S. capital equipment grew in the first half by 15.5%. Almost all of it was tech equipment. You can look at the S&P 500, how much of the tech companies driving it. And as a result, you have to sort of pass out all of these 3 factors. And the big call is that how long will this tech cycle last? We know that it's not related to the cycle, but how long will it last? So I think there are these 3 things that are driving that wedge that, growth has been very strong globally, at least stronger than expected. But just because it hasn't happened, doesn't mean it won't happen.
Never will.
Jahangir, the entire premises has been the huge deficit that U.S. is running with respect to trade. And this tariff has been to get that deficit lower. What is the kind of impact that you see for the U.S. as a whole? There's some figures of $300 billion of additional revenues coming for the U.S. Do you think that it's going to help in some way to bring down that huge deficit?
No, so the deficit, what happens to the trade deficit and what happens to the tariff, this thing, etc., are 2 separate things, right? So there are different ways of looking at it, right? One way of looking at it is to say that whatever the trade deficit or current account deficit is, that's just what U.S. needs to borrow from the outside world to meet its fiscal deficit, given what is happening to domestic savings, right? So if you have fiscal deficit going up, it's not going to go up to 7% if you believe that all of the $500 billion of tariff revenue is going to come, but it's going to go up from around 6% to about 6.5%. So you have a 0.5% increase in fiscal deficit in the U.S. Who's going to fund that? In the last 8 years, no one really ever was concerned about it because it was a reserve currency. If fiscal deficit goes up, it's going to be funded by foreign borrowing, which means that the current account deficit is going to widen. But now you have an administration that is targeting that too, as you rightly pointed out, with the tariffs. So whether or not the trade deficit widens or narrows depends entirely on who is going to fund that 0.5 percentage point of higher fiscal deficit. If the domestics are willing to fund that through higher savings, then current account deficit can actually fall. But if the domestics are funding that with higher savings, then either consumption or investment or both need to slow. That's the only way you do get higher savings, which means growth rate in the U.S. is going to slow down. So there is no such thing as a free lunch.
What happens in India's case? Because kind of the same story playing out. While consumption is getting that fillip, you've got the RBI backing it, government, etc. as well, trying to propel growth into the economy. But then what happens to CapEx?
So, look, we've been crying about CapEx and, hankering about CapEx since 2012. Corporate investment as a share of GDP has been flatlining since 2012 at 12%. At some point in time, we have to give up this thing that, this is cyclical reasons. It's because of, GST was imposed. It was because the banking sector was weak. Now the banking sector is back. It's because of this, that, and the other. You can't have corporate investment flatlining at 12% at 13 years and then say, this is not structural. It's a structural story. It has very little to do with cycles. I know we want to believe in green shoots and cycles and every pop-up glass half full thing. 13 years we've been talking about it, right? At some point in time, we need to step back and say, look, there is something structural about India's corporate sector. And that's where I think the debate has not been there. It's always been focused in India on what are the cyclical factors, what is the proximate cause, and we've always blamed, now we're going to blame tariffs and external headwinds. Previously, we blamed the banking sector. Before that, we blamed the introduction of GST. I think we're running out of excuses. We need to really actually find alternative engines of growth. And the corporate sector is, flatlining at 12% is because there are no alternative. We haven't identified alternative sources of growth.
So what is the solution?
The solution is that we basically go back and figure out what has been the reason as to why we had this massive increase in corporate investment back in the period 2002-ish to about 2008-9. We had the global financial crisis. Why did it actually fall in the global financial crisis, and why has never really picked up? It has to do with the corporate India not fully buying into the domestic-driven or the export sector-driven story. They have to buy into that idea. They haven't. I mean, that's the only obvious explanation I can come up with.
What about the domestic story? Because you have consumption in domestic, and that's, if you look at India as a whole, we are not so much dependent on exports, but we have a good domestic story which is going on.
So and you take investment either in growth rate, overall investment, or as a share of GDP, then take exports growth rate or exports as share of GDP, draw the two lines, there is no daylight between the two of them. We are an exceedingly open economy. We do not want to actually acknowledge that. And I think that is one of the, in answer to your question, that is one of the first acknowledgements we have to do. Literally, take investment as a share of GDP, take exports as a share of GDP, basically there is no daylight.